analysis as to what's happening in our world. But, I want to ask you a couple of questions right in front of our listening audience about what is happening in China, what the impact is going to be on the global, I would say this push towards the global financial reset. I see us in a global financial war, this currency war that's going on behind the scenes. It's not totally transparent, but is it not a financial war, a currency war happening?
It definitely is. We've been calling it the global financial crisis since the Lehman event in 2008. We've had the 0% policy since 2009. We've had QE in place for hypermonetary inflation, purchasing bonds, and a lot more than just bonds since 2012. So we're in a global financial war, and its current phase is a powerful currency war. I've been making a statement, Pete, for the last 2 years. It's not exactly an easily understood perspective, but I've been saying that the dollar is going to rise, then rise some more, and then vanish and be replaced and go out of existence. In other words, die. And I get a lot of confusing email. I should say email from confused people that say, no, the dollar's not crashing like you said. I never said it was going to crash. I said it was going to vanish. But it's right now, it's like a hot air balloon that's rising so high into the stratosphere that it's going to explode because the outside pressure is getting weaker and weaker. The balloons are going to pop and explode. So look at the outside pressure pretty much as competing currencies. I made a comparison in a public article a couple of weeks ago that the U.S. Treasury bonds were acting like a black hole. You're seeing a lot of corporate bonds and weaker corporate bonds called junk bonds. They're selling off. They're cratering. They're losing half their value suddenly. And with those proceeds, people are buying the Treasury bond. But you're also seeing weaker currencies get even weaker still, and they're taking the proceeds from selling and buying. Well, they're not just taking proceeds; they're transferring, like a weaker currency, say the Brazilian real. They're just buying the U.S. dollar. So you're seeing weaker bonds and weaker currencies shoving all those funds into the Treasury bond, while something else is going on, and that is capital is getting dissolved and retired. In other words, say businesses are closing down certain segments or shutting altogether down, and all their business equipment gets liquidated, taken offline, put in a warehouse. And what does a business do with the extra money? They put it in Treasury bonds. So it's a black hole, Pete.
Let me ask you this:
if you don't, global war.
If you don't mind me asking you this,
a hot war.
Everyone's been following this thing with China, and by the way, I know that you're not afraid to stay. You're not afraid to connect the coincidence of what happened in that port in Tianjin. And the timing of that event shortly after a devaluation. But there's a lot of us, I call us steak and potatoes people, that are looking at this thing saying, what is a Chinese devaluation? And why did this massive explosion happen shortly thereafter with them claiming that they wanted to declare martial law? What does a devaluation mean on the global currency landscape?
Well, it means that the Chinese are going to try to make cheaper their exported products. And that means they're going to be competing against Japan regionally. One thing that the Americans are not looking at sufficiently now, and they will, because they're slow to get to it, is that with the Chinese devaluation of the currency, they undercut Japan. And Japan is like a satellite nation to the United States. We control their central bank. We control the Bank of Japan. So I look at it from a global perspective at the same time. The Chinese devalued their currency, and that lifts the dollar. And they've triggered other nations to devalue their currency, like India, like Thailand. And Thailand had another explosion in their capital city of Bangkok, by the way. It was the biggest explosion in their history. So the devaluations seem to have a connection with bombing events. Now, if you have a group of nations that are joining in the currency devaluations, you're getting the competing currency war. And all of them are lifting up the dollar. Well, the American leaders, the U.S. government leaders, the Wall Street maestros, I call them, masters of the U.S. government, they don't want the dollar to go up faster. They've been talking about how the dollar is rising because we're the only nation with a growth, a growth in the economy, and it's ludicrous. We've got perhaps a -4 or -5% recession every single year. They don't properly remove inflation. They remove 2% when they should remove about 8%. So they're lying on the GDP by 6%. All right, so the American leaders are saying we boast here of a strong currency. But now if you've got a global currency war at work, all these nations, it's called beggar thy neighbor. And it's not called a war without a reason. China's reduced their currency, which makes their exports cheaper. And they're going to do damage to Korea and Japan, but watch Korea do a devaluation also. What you're going to get eventually is the whole world concluding that the dollar has risen too much. So it's now a problem.
So it's not unreasonable to say, when I say the connection between an explosion shortly after a devaluation, it's not unreasonable to say that there is a military counter to their financial strategy to devalue and control their exports, especially when the attack is taking place on a major export port, correct?
Yeah. I mean, we can't really avoid this Tianjin event.
No, sir.
I just saw a picture tonight. It wasn't the first time I saw the picture, but it looks like about a 2-mile diameter hole. You don't get that from a standard kind of explosion. You get that from a micronuclear explosion. Small scale. But, you know, I don't want to get into this topic too much of the military response, but let's just talk about what Tianjin is.
Yes, sir.
In my August newsletter, I had a good rundown, a couple of paragraphs about what Tianjin is. Well, they've got a giant automobile fabrication plant, car making plant for Volkswagen. And they lost about 3,000 cars sitting in the inventory lot. Okay, there was also a big explosion of certain gas depots, not gasoline, but gas substances. And it appears that there was a cyanide explosion, and I don't think cyanide was stored there. I'm not sure. That there might have been some cyanide depots at the port, because cyanide is used in a mineralization refinement process for gold. The cyanide treatment for gold, and heap leaching has kind of superseded that. Okay, there were 21 ports in Tianjin that were affected. 21 ports. I don't know that even Long Beach, California has 21 ports.
No, sir.
And there was another, much more important facility near the Tianjin location where the blast took place, and that is their supercomputer.
Oh, really?
They've got a supercomputer with a 1,000 square foot footprint, 1,000 square meter footprint, 1,000 square meter footprint. And that supercomputer is a logistics center for all kinds of technology companies in China. It's also a control center for banking information. It's also a logistics center for their space program. It's also a logistics center for their port facility there. Mm-hmm. And it's also a logistics center for their military, the Chinese military, where the hacking takes place.
Oh, wow.
So, of all the different sites in China, it's not difficult to conclude that Tianjin is the #1 strategic target.
Yes, sir.
Okay, so that's the response to the Chinese currency devaluation, Pete.
Mm-hmm. Yeah.
Now I asked the Voice. The Voice is my the European native, but he's a gold trader extraordinaire. He's got a Rolodex that'll blow your eyes off. Central banks, Arab Emirates, Hong Kong billionaires, you name it. Mm-hmm. He's got them as clients, and he's got a lot of interesting stories, therefore. But I asked him, what is the Chinese response going to be? And he said, they will do the Sun Tzu method of retaliation, let the U.S. and the West sink from their own vulnerabilities. They will wait for their timing to deliver a drip, drip, drip water torture, Chinese style. And I said, do you think their response is going to be an international acceptance of the Chinese RMB currency to be used in trade settlement by all the emerging market nations, all the BRICS and the alliance nations, primarily the Eastern Hemisphere nations that have massive export trade? And he said, yes, exactly. Their response is going to be, again, with the RMB. First, they devalue it, but then they're going to have all their friends require RMB for trade settlement. And the big climax point in this direction will be the Saudis and the other Gulf Emirate nations, the Arab nations, and not just Arab, it'll be the Iranians too. Mm-hmm. They're going to accept RMB for payment of oil shipments.
Oh, that's a weaponization of their RMB, isn't it? That's going to be the shot across.
I think so. They're going to weaponize it with trade in broad usage.
Wow. Doing
so will essentially force nations to diversify out of treasuries in their banking system.
And that's already happening right now worldwide, aren't they? Aren't they trying to move as far away from the U.S. Treasury? Right now, they can't necessarily do it. As it relates to the petrodollar, they see that day coming where the RMB may become that reserve currency, correct?
Yes, I think it's happening in two steps. The first step has occurred in the last couple of years, and that is nations are not buying treasuries with their surpluses. Mm-hmm. There's really a stagnating effect of foreign nations buying treasuries. The next step will be outright net sales out of their banking system. Why would a country like Korea hold on to billions and billions in treasuries when they're not going to use it in trade? Mm-hmm. So that's how they decide, all right, what do you say we get rid of a third of all the treasuries that we own, let it be known, announce our diversification, and do this sale over the course of 3 or 4 weeks or 3 or 4 months. And then you're going to see explosions in Seoul, Korea.
Yes. Now, let me ask you something. Treasuries have been very safe and secure with the U.S. dollar as the global reserve currency. Propping up, pegging to the dollar with the petrodollar. Countries have gone to the U.S. Treasury for flight of safety per se. When we see countries like China right now dumping these treasuries, that means that they don't feel that the Treasury is going to be safe in the future. Correct? Is that the assumption? The correct assumption?
Yes. You can't have the dollar as safe haven with its trading vehicle, the treasuries. Mm-hmm. You can't have the treasuries as the safe haven if we have QE in place. The quantitative easing is hyper-monetary inflation, Pete.
Yes, sir.
We're printing money to cover our debt. Pretty soon we're going to print extra money. I'm calling it QE4. It's not announced yet, but I think we're going to we're going to announce a new QE round with even higher volume to cover what foreign countries dump in their treasuries. Countries like Korea, countries like Brazil, they're sitting on treasuries. And they're realizing, wow, the Fed is undercutting their value with African-style monetary policy, printing money to cover the debt. This is what Zimbabwe did. We've got a Zimbabwe African monetary policy in the United States, and it's going to discourage nations of the world from holding it anymore.
I saw an article recently that said that with China's dumping of these treasuries at the volume that they're doing it is essentially the equivalent of canceling out $1 trillion worth of QE. Is that a pretty accurate statement? We did all that printing. They dumped the treasuries. We just basically blew our QE wad, per se.
Well, we've been doing, I think, $1 trillion a year in QE. The Chinese are dumping $100 billion a month right now. And they have 2 months down and maybe 7 more to go. It's going to be kind of interesting, Pete, to see how much treasuries the Chinese actually have, because I think they've been lying. I don't think they have quite as much as they say they do, because I think they've made commitments to get rid of their treasury bonds for quite some time. For instance, they might have, committed $250 billion worth of treasuries for swaps on future Hong Kong dollars. I mean, we don't know what they're doing. They don't announce what they're doing. But they have the latitude of committing a good portion of their treasury bonds held in reserve in exotic purposes. I just raised as one possible example. We're going to see a pretty interesting move up in the Hong Kong dollar soon.
Oh, really?
Yeah. They're going to break their peg. They've got a peg at I think it's 7.5 or 7.75. Yeah, 7.75. And it's been in place for 15 years, ever since the British left in 1999. So you're going to see a lot of nations depegging from the dollar. You're going to see a lot of nations diversifying their reserves out of the dollar. And you've got to think about what the reserves are. A nation has export surplus. They store it in treasuries. They put them in their banking system. And those are the asset foundation for their entire banking system. And we're undermining banking systems with QE.
Yeah, and let me ask you this, if you don't mind, as we upswing to the top of the hour here. I have you until the top of the hour. The Fed will have options as we're in full-blown collapse, as these moves are made. What options are left? You're saying you're calling for QE4 as an option. That's going to cause, obviously hyperinflation, depending on how much they actually print. But what options are available to the Fed to stave off this collapse? They have to make moves. They have ammunition available to them, correct?
Yeah, well, the Fed, ever since QE came on, has been doling out hyperinflation ever since 2012. The key is that it's not getting into the mainstream U.S. economy. It's not getting into the real economy. It doesn't get into business investment. You're not seeing companies saying, well, we're going to tap the 0% and open up a new plant and hire 1,800 people. You're not seeing that. So you've got hyperinflation in the finance sector, while the real economy is deteriorating rapidly, caught in what I believe to be a mild depression. So what options do the Fed have right now? Not many. They can't raise rates. They'll kill the entire treasury bond complex in 6 weeks. All they can do is lap up all of the treasuries that are dumped and diversified out by nations of the world. I call it QE4, but I'm starting to come up with a nickname, QE to infinity squared, because I've said that for 2 years now, we're caught in QE to infinity. There's no limit on what they're doing. Let me give you an example, Pete, of how this is unlimited. They claim that it's $40 billion a month. But we have something called failures to deliver by mostly Wall Street banks, but they're big banks. Mm-hmm. It's failure to deliver on sold treasuries. And it's at a volume of $40 billion of treasuries per day.
Are you kidding me? Wow.
Failures to deliver. So who's doing the selling?
Yes.
I think it's predominantly Wall Street. They're doing naked short selling of treasuries, taking in money from the Fed. This is hidden QE. The Fed is paying the money, and nobody is receiving on delivery the treasuries that the Wall Street banks are selling naked.
What the heck?
In other words, Pete, it's $1 trillion a month of hidden QE.
You've got to be kidding me. Wow.
Wouldn't you think that's pretty good for the Wall Street bank's liquidity flow?
It is. And where's the stuff? Where's this, our wealth? I'm calling it our wealth. Where's it being extracted to? Are they taking it offshore? Because just like you said, this isn't coming all the way down to Main Street America. No productivity is resulting. Where's all this money going? Where's it flowing?
I think they're offsetting right now with a gigantic move in these failures to deliver, the naked shorting of treasuries. They're covering derivative losses. We all talk about how, oh my gosh, don't we have $700 trillion worth of derivatives that are serving as a phony foundation for the Western banking system? Some of this, Pete, is the petrodollar derivatives.
Yes, sir.
Linking the dollar to crude oil, and they're all being dismantled. And that's one of the reasons why the dollar is rising. You're having big contracts liquidated as part of the dismantled petrodollar standard. Mm-hmm. And when the contracts are liquidated, like suppose it takes place in a French big bank. Well, the French big bank has to pay the holder of the derivative in dollars because all the derivatives are in dollars. And that's artificial demand for the dollar. That's what's pushing up the dollar. But then you've got all the vicious cycle things working a smaller country like Brazil sees its real currency go down because the dollar is going up from the liquidated petrodollar derivatives, all those contracts linking oil to the dollar. People ask me, explain what a petrodollar derivative is.
Yes, sir.
It's just an enormous exotic contract linking the crude oil price with the dollar as an anchor. Well, they're being pushed to the side. They're being dissolved. They're being dismantled, which means there's all kinds of artificial demand for dollars. It's not for expansion of the U.S. economy, all this dollar expansion. It's covering derivatives that are failing.
Now, Jim,
so the dollar goes up. The Brazilians realize their currency's going down, so they get rid of some of their assets held in financial form in the banks and investments and whatever, and they convert to dollars. So they add to this problem by converting on a weaker currency to buy more dollars and push it up. We got a vicious circle working.
Jim,
to push the dollar up, and it's going to be pushed up into the stratosphere where it breaks.
Jim, I was told back in 2006, 2007, as we were approaching the subprime mortgage meltdown, a good friend of mine, he said, this is what you need to look for. And he described this, and I want you to educate me and tell me if what he said was true. He said, once we see the depegging of the trading of oil to the U.S. dollar, he said that's where the United States is finished. We would have an option either go into a deep, dark depression or all-out World War III. He told me that in 2006. Is that true? Tell us.
Yes, exactly. Yes, exactly.
Really? Okay.
I think we're going to get a depression and not an all-out war. We're going to get an accelerated strategic war. For instance, after Tianjin took place, the entire metro New York and parts of the Northeast Seaboard, all the airlines' databases went offline.
Did they really? Wow.
Yeah. It happened for about, I think, a 48-hour period. Okay. Now, that was all the different airports connecting to New York. So it didn't just affect Metro New York. All the airports that touch New York, like Philadelphia, Baltimore, Boston, all of them, Chicago. Okay, so we're going to see a depression. And the depression, in my opinion, has already started. You can't have 6 straight years of -4 and -5% recession without calling it a depression. It's a mild depression and a horrible recession. But here's where your friend in 2006 can be linked to today. I just, in my hat-trick letter for August, I just had a section on all the oil damage. We've got about $1.5 trillion in losses just in the energy sector just this year. We've also got all kinds of losses for the marginal energy firms like shale and fracking, like the drilling platform companies. Hercules just declared bankruptcy. Sabine just declared bankruptcy. Most of these companies have bonds now that are down 50 to 70%. You're having now $1 trillion losses in the energy sector. But here's where it gets even worse, Pete. Some of these companies have hedged against the oil price. So they put in oil hedges. These are not derivatives. These are hedges. They've done hedges. In other words, what they've done is, just think of like Exxon. Exxon put on a giant hedge for 80% of their production of oil, and they made it as though they sold oil for $100 a barrel. I'm thinking of gold. $100 per barrel is their equivalent net sale proceed because they put on the hedge against a falling oil price when oil was $100. Okay, I don't know if you're familiar with hedges, but it's a zero-sum game.
Yes, sir.
So the underwriter of the oil hedges is on the hook for trillions in losses, and that's the Wall Street banks. The falling oil price and the dismantled petrodollar standard and all those derivatives are the death blow. DEATH. Right. I think my mother, DED, dead. No,
yes.
It's multi-trillion-dollar losses are coming to the Wall Street banks as counterparty for oil hedges. Now, we've gotten some examples of the power of these losses. A couple of oil firms have discharged and taken away their oil hedges. And they did so a few months ago. So what they were doing was saying, okay, we think the worst is over for the oil price, and oil is going to bounce back up toward $80. So we don't need the hedge anymore. Let's lock in those profits. We'll show a good quarterly gain, and we'll ride without any hedges for the next few quarters. Oops, they're dead because the oil price did not come back, and now they're selling oil way under their costs.
Right. Without a hedge.
Without the hedge. So the companies that got rid of their hedges are going to die. And that is your example of what's going to happen to the Wall Street firms who maintained the market, made the market for oil hedges. If Exxon can sell at the equivalent of 100, it means that Morgan Stanley is absorbing those losses. You've got multi-trillion losses coming for Wall Street.
All dependent on the U.S. dollar being pegged to the trading of oil, the petrodollar. It's all tied in.
That's dismantled, though, Pete.
Yes, okay.
Right. And once you dismantle that, you saw the dollar rise and crude oil fall.
You know, Jim,
and enter into the vicious cycle where weaker bonds buy the Treasury and weaker currencies buy the dollar, so it accelerates the dollar move. And now China has just added to that with a devaluation joined by India and joined by Thailand And I guarantee you it's going to be joined by 10 other countries in the next month.
Jim, we have 2 minutes, about 2 minutes left here. I want you to